Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today, we've got some very adult topics to discuss. We will mention Bitcoin, we will talk about the stock market, and we will spend considerable time today discussing the economy. I want to talk about the Federal Reserve's intentions, the words they're using, the wealth effect, inflation, the labor market, debt to GDP, quantitative tightening. We need to better explore the economic landscape so that I can lay out for you the depth of my thesis over the next couple of months. So don't go anywhere. This is a very important video. If you enjoy my content, make sure to give this video a thumbs up and please consider subscribing to the channel. Your support allows me to continue producing great content and doing the things that I love, so I appreciate your support. But let's not waste any more time and get right into it. Bitcoin price is around 29,500. It's currently holding above the 2021 open, seen here on a monthly chart, and we're waiting to see if support is held along this 18-month low here that has provided such stout psychological support for Bitcoin for the last year and a half. On the weekly chart, we did just complete our 7th red weekly candle in a row, which has not ever happened before for Bitcoin. This is a new pattern. We haven't seen this before. We're currently working on our 8th consecutive red weekly candle. I don't put too much stock in the streak being broken and us now having 7 consecutive candles in a row. That doesn't really have a lot of meaning, but you see people mentioning it on Twitter. It is true. And I think if anything, it's indicative of the current economic climate. Everything is down. And the real question on Bitcoiners' minds is whether or not this was the capitulation wick that would mark the bottom for this part of the cycle. You can see it's very high volume on the weekly chart. We had this flush wick down to below 26,000 and it was bought up back above 2021 support. That's positive to see. When we go down to a 3-day chart, we do see increasing volume, extremely high volume here on the May 12th wick. That was the day that Terra Luna was collapsing, which we explored in detail over the last couple of videos. I'll leave a link in the description down below if you'd like to watch our review of what happened to Luna. And I've seen some pretty smart traders on Twitter pointing out that this high volume here in their estimation marks a capitulation bottom, but I'm not so quick to agree with that. I think that it requires rolling in some of the greater context for the market and looking beyond just Bitcoin. Even though people love to focus only on Bitcoin, it is part of the greater market. Conditions right now are not conducive for this having been the bottom. And when we look back just in the history on the chart here on this screen, there are times when we have extremely high volume and it doesn't mark the end. If you look back here in May, this was massive volume. In fact, the only volume we've ever seen close to it was last week. This is on Coinbase, by the way. And this high volume did not mark the capitulation. There was another lower wick here and multiple weeks of continuing to drag down through May, June, and July before the bottom was actually put in. So needless to say, I don't believe that the capitulation is that clear cut. I think it requires some awareness of the macro situation, which can't be ignored. And there are a lot of Bitcoiners and traders who seem hell-bent on ignoring it. And in my opinion, that is disadvantageous for them. Now, a quick glance at the equity market shows that over the last few days, there's been a bit of appreciation in equities. The Dow, the NASDAQ, the S&P, they're all creeping up a little bit while Bitcoin stays sideways. Now, today, this morning, we are seeing a big gap down in equities. And I think part of that is led by weak earnings coming out of retail today. We'll talk about that in a moment. And if I had to guess, because of the correlation between Bitcoin and equities over the last couple of years, when I see in this current week, I see equities rising, while Bitcoin doesn't really do anything. It's actually still in the same price range it was in over the weekend. I think actually Bitcoin is telling us not to believe the pump. Don't believe it. I think there's still a fair amount of disbelief in equities. Now, one, they benefit from passive investing. So there's constantly an inflow from people who have retirement accounts that are buying FANG stocks and Vanguard funds and you name it. People don't stop paying into their 401ks just because we hit a bear market. So that flow is always there. But I think when you see Bitcoin completely refusing to move up over the last few days, I think that this is more indicative of true market sentiment. And I think that maybe equities have an opportunity here to revert back to the mean, which would be lower. Though we'll have to see how it plays out. Again, that's just a framework. That's something I think may happen. So what I'd really like to discuss now is the economy and the American consumer and how it relates to what the Federal Reserve is doing. Over the last couple of days, we've gotten earnings from Walmart and from Target. Walmart earnings had higher revenues. They surprised revenue to the upside, but they were lower on earnings. They're also reporting a glut of inventories, and they have lowered their guidance for the rest of the year. Target is exactly the same. Higher revenues, lower earnings, inventory gluts, and lower guidance for the rest of the year. Target, and more so Walmart, represent the American consumer in its most pure form. Walmart especially, as the largest private employer in the United States and as the most affordable retailer for the average American, they represent consumer strength. And when you look at what Walmart's earnings did, they got pummeled by EPS. Their inventories are overloaded and they aren't selling products at the pace they were before. Granted, they're still earning money. The top line revenue value rose because people are still spending money. But when you see the glut of inventories, when you see lower earnings, and you know that inflation is as high as it is, particularly in food and energy, it's showing that the consumer is still spending out of necessity, but they're getting far less with it. And this is a problem because US GDP is 70% consumer spending. Here on this top line is gross domestic product for the United States. It's in billions of dollars. Shown here as 24,382, that is $24.3 trillion. Personal consumption expenditures are $16.7 trillion of the $24.3 trillion that make up US GDP. That means that consumer spending is more than 2/3 of gross domestic product. The consumer is what powers the American economy. And when you see Walmart and Target both showing significant weakness, that's telling you a story about the American consumer, that they are still spending money, but they are getting less for it. And it threatens GDP. GDP is a representation of growth in the economy. Rising GDP means businesses are doing well, revenues are growing. Typically, the labor market is also positive, and it means that the economy is in a relatively good place. And why is it important that we're seeing a weakening American consumer? Because the American consumer is significantly responsible for levels of demand. And when you have a strong American consumer, you have high demand. And by the words of the Federal Reserve, which we are about to explore, demand is still far too high, and it's contributing to inflation effects. So what I want to do now is explore an interview that Jerome Powell gave last week to marketplace.org, and there are some very important insights within this interview that give us a sense of what the Fed is intending to do. So I'm not going to scroll through this, but I've taken some excerpts and highlighted places where comments are relevant to our study today. All of these highlights are Powell's own words. And when a Federal Reserve member gives an interview and they don't have canned comments, those can be incredibly insightful because these are the people who are making extremely impactful monetary policy decisions, and watching the way that they answer questions off the cuff can be very telling. So the first thing Jerome Powell comes out and says is, what we can control is demand, but we really cannot affect supply with our policies. So the question about whether or not we can execute a soft landing or not may depend on factors that we don't control. So what is he saying here? A soft landing in econ speak means seeing slower growth without sending the economy into a recession. So Jerome Powell is proposing that a recession may happen for reasons that the Fed has zero control over, because by his own words, they cannot control supply. They can only control demand. And much of the inflation that we're dealing with now are because of supply shocks, because of tightness in commodity markets, because of shutdowns to supply chains in China, clogging at the ports. All of these are playing into supply shocks that are driving inflation. Not to mention disincentivizing exploration in American oil production. That is also playing a role on inflation, on oil inflation, which is then driving up everything else. So there's a lot of factors outside of the Federal Reserve's control that are driving inflation. And the only things that they can really affect are the demand side. They do that by tightening financial conditions. The next thing Powell says, we have the tools and the resolve to get inflation down to 2%, and we're going to do that. The process of getting inflation down to 2% will include some pain, but ultimately the most painful thing would be if we were to fail to deal with it and inflation were to become entrenched. So their target is 2% inflation. Now, this is inflation up here at the top, and for many years, they were able to keep inflation around 2%, 2 or 3%, and that's usually their target. But if you look over here recently, you can see inflation is over 8%, and on a 3-month basis, it's still accelerating. Even though the recent couple of prints have been lower, the 3-month basis of inflation is continuing to accelerate. So this is a serious problem for the Federal Reserve. And when you look down at the other two factors that play into inflation, this middle here represents consumer expenditures, and this bottom represents producer prices. So these are all different layers of price inflation, and all of them are vastly elevated from historical norms. So we can see that we have inflation well over 8%. It's been over 2% now for a couple of years. On a 3-month basis, it's still accelerating, and the Fed wants it down here at 2%. They want this blue number to come all the way back down to 2%. And as they mentioned, all they can do is kill demand. Because as Powell says, employment is very, very low, and the labor market is extremely tight, while inflation is very high. Demand and supply are out of whack. There's too much demand. There's more demand for workers than there are people to take the jobs right now by a substantial margin. These are Powell's words. He continues to say, there are 2 job openings for every unemployed person. In principle, you could moderate demand, reduce demand to the point where job openings move down substantially and the labor market gets closer to being in balance. So I want to unpack this here. What he is saying is that demand is too high, the labor market has not responded to this high inflation, and we're seeing a bunch of job openings. There are 2 jobs available for every person seeking employment. Now, never mind the fact that the labor participation rate utterly collapsed in 2020 and has not returned to pre-COVID highs. Let's also forget the fact that the labor participation rate has been declining since the dot-com bubble burst in 2000. This entire millennia has been a decline in labor participation. What the Fed cares about is the unemployment rate, which is down here at 3.6%, a pretty low value historically. So they don't care that there aren't a lot of people looking for jobs. What they care about, to use his exact words, is that there are 2 job openings for every person seeking employment, and that they still believe demand is too high. So as he says, our goal, of course, is to get inflation down to 2% without having the economy go into recession, or to put it this way, with the labor market remaining strong. The one thing we really can't do is fail to restore price stability. Nothing in the economy works. The economy doesn't work for anybody without price stability. We cannot fail to restore price stability. So I know I'm going through a lot here, but this is very important to unpack. The Fed sees inflation as its #1 problem. It has a dual mandate to maintain price stability and full employment. Right now, it sees this value, this unemployment rate, as signifying a strong labor market because there is a low rate of unemployment and there are a lot of job openings that people don't seem willing to take. And as a result, wages continue to rise because demand for labor is not being satisfied by a supply for labor. So wages are continuing to rise, and inflationary pressures are also continuing to rise while the labor market remains strong. So what the Fed is telling us is that inflation needs to come down. The only way that they can do that is by stalling demand, and they believe that they have more to push before the labor market begins to weaken. So they're going to continue to do that, to continue to push us to tighter and tighter conditions so long as the labor market does not roll over. Because in his own words, you could moderate demand, reduce demand to the point where job openings move down substantially, the labor market gets much closer to being in balance. So how does the Fed stall demand? Some of you may be wondering. What do they do? How can they actually make demand slow down when they admit that supply shocks are creating inflation? They can't do anything about that. Well, what they can do, friends, if you are a central bank, the most effective way to stall demand is via the reverse wealth effect. So what is the reverse wealth effect? Well, it's the opposite of the wealth effect, shown here from Investopedia. The wealth effect is the suggestion that people spend more money when their assets rise. They see their paper wealth growing, they feel more financially secure, and they spend money on goods and services that power the economy. And the things that make people feel wealthy is when their homes and their stock prices go up, when the things that they own are worth more money. And what have we seen over the last 2 years? A significant wealth effect for Americans that own homes and have 401k retirement accounts. That pocket of Americans have felt significant wealth effects from the vast stimulus that we engaged in over the last 2 years to try to rescue the economy from the pandemic. I would argue they did far too much rescuing. There are many Americans over the last few years with retirement accounts that have seen their stock prices rise 40% from where they were before the pandemic. Anyone who actually jumped in and bought stocks during the crash was up over 100% this January. That creates a significant wealth effect for anyone with exposure to U.S. equities. Additionally, there's been a strong wealth effect with homeowners. Now, many of you are aware that home prices are skyrocketing as well as mortgage rates. But really, the value of the American home has given a lot of Americans a false sense of wealth and security. And it's actually offset much of their concerns about inflation. So let me explain. Here on this chart, we're looking at two different values. The blue bars represent the median household income for the United States. The black line represents the median home price year over year on a quarterly basis. This goes back to 1984, and the median American income as of 2020 was $68,000. Over the last 2 years, home prices have been rising and rising and rising. And as recently as Q3 of last year, home prices in America, the median home, so the home in the very center of the market, had risen by $74,000. In 1 year, that means that Americans, on average, the median American home, earned more paper wealth from their home values going up last year than they did from working a job. That has never happened before. Literally, never happened before. Home prices were up as much as 22% year over year in Q3 of last year. $74,000. Do you think that these people in this particular bucket are experiencing inflation the same way that a rental is? Absolutely not. When you look at worker wages, this data updates more regularly than the median household income. The most recent data I have for household incomes is 2020, and it's $68,000. But worker wages, as recently as Q1 of this year, are up 5% year over year. So let's do a little math. Let's assume that the median home income is also up 5%. That would put them at around $71,500 per year in salary. Their home still made more than them. So they actually earned on their net worth by sitting at home. They could have quit their jobs and made more money simply by owning a home. So let's package this up here. We've got the Federal Reserve telling us that inflation is high and it is their mandate to bring it down to 2%. Let's just suspend belief as to whether or not we think that they can get there. They are intent on presenting a serious front about getting there, and that means tightening financial conditions. In Fed speak, that is a euphemism for asset prices coming down, for the reverse wealth effect. They need to make Americans who are still continuing to spend money feel less wealthy. And the only Americans who feel wealthy, or at least feel secure in any of this, are people who own homes and have retirement accounts, because their paper wealth, their net worth, has grown exponentially in the last couple of years, and it has almost fully offset inflation concerns. Whereas the other half of Americans who rent their homes and do not have stock exposure, those people are feeling inflation at the register. They're feeling it with their landlords, and they are the type who would cause civil unrest. Those are the people calling their politicians and saying, you better do something about this, or I'm not voting for you later this year. That's the motivation here. That is the crux of all of this. It is political pressure being placed on the Federal Reserve to deal with inflation that they have no control over, because it is largely driven by fiscal spending from Congress over the last couple of years and supply shocks, which are fully out of their purview. So So all they can do is continue to threaten the market with tighter conditions, continue with quantitative tightening, continue with raising interest rates, and they can't allow asset prices to rise in the meantime. They can't present a serious front about inflation and demand while also sitting by and watching the stock market rip in their face. I think the market runs a severe risk of getting too cute over the next few months, pricing in a pivot too soon with a Federal Reserve that admits it doesn't know what's going to happen 2 or 3 months from now. And if it gets too cute and assets start running when the Fed is still trying to deal with inflation, we risk getting an overtly strong policy response out of Jerome Powell. And no one wants to see that. Just to add to my point about the stimulus over the last couple of years, what we're looking at is median income in G7 countries year over year. This last section is 2020. There are only 2 countries in the G7 who saw median incomes rise during the pandemic: Canada and the United States. United States is in black here. All of our other G7 compadres saw median incomes fall because their economies did not overstimulate in response to the pandemic. Their citizens did not have a wealth effect as a result of shutting the economy down, whereas many Americans and their Canadian friends to the north saw their net worths rise. They actually got wealthier during the pandemic. Americans by 4.5%. So yeah, we've got a wealth effect that we need to reverse. And by the Fed's measure, that means reducing asset prices. And the juiciest targets right now, friends, are Americans with homes and stock portfolios. So that's the crux of my thesis, and it's based on the direct words of Jerome Powell and the economic data we are seeing unfolding. If the American consumer is weakening, as we are exploring with Walmart and Target's earnings, if this sets off a chain of additional weakening results out of various retailers, that may start to show the Fed that some of its policies are working. And even though the bond market has fully priced in all of their rate hikes, they've continued to beat the drum that demand is too high and they've got to do more. And the stock market and the housing market have not responded to their satisfaction yet. They're going in the right direction, but we're still getting a lot of hawkishness out of this group. When I see things from the Fed governors, like what I saw from James Bullard yesterday, where they have very mixed messaging about their plans for the next few months. He says things like, our most pressing issue is inflation. We have a good plan in place to bring it down. But then he also says, it's not exactly clear what the effects of shrinking our balance sheet will be on the economy. At the same time, he also says, we expect continued positive growth for the United States for the next 18 months. Friends, none of these ideas are in harmony with each other. You cannot, with a straight face, say that you expect US GDP growth to be positive over the next 18 months, while also saying inflation is too high and we have to bring it down, while also saying nobody knows what quantitative tightening will do to the economy. The Federal Reserve doesn't know what's going to happen more than a month or 2 in advance. They're playing this by ear, and they are massaging sentiment as they go. And while the market has responded aggressively to their hawkishness, they are still fearful that not enough has been done yet. So they will continue to be hawkish. They will continue to position themselves as the slayers of the inflation dragon. And they'll do that until the market forces them to change their mind, either because the labor market weakens significantly or credit spreads begin blowing out because of the cost of capital rising too much. It's hard to say what the trigger will be, but I do believe they cannot continue this charade for too long because we have a debt-based monetary system, and sustained austerity measures are not conducive to a healthy economy, not when everything is based on credit. And where we sit currently is nearly the highest debt levels we have ever had in relation to GDP. The only other generation that saw debt to GDP this high was the World War II generation, and that was record stimulus to rebuild the world after war. So it's a very different environment than what we are in now. So the charade of continuing to raise interest rates while debt levels are this high threaten the solvency of sovereign debt. So there will be a reckoning point at some time in the near future where they simply cannot continue to tighten. Something will force them to reverse, and it's unclear right now what that will be. But we come together, we look at all this data, we pay attention attention to what they're saying, and we create a framework of possibilities. Now, I know a lot of this seems scary. I don't present this information to you to be overly bearish, to give you concern. It's to make you aware, and it's to add nuance to what can often be a very blunt and binary conversation about how the Fed should manage this situation. There are a lot of people waiting for them to flip the green switch for QE infinity and to start pumping us back to the stratosphere. And I don't think that there is much of a political appetite for that right now because of the inflation pressures, because of the constituent of Americans who don't give a shit about the stock market. They don't care about home prices because they don't own any of that stuff. What they care about is how much food costs, how much gasoline costs, and they are people who vote in large numbers. So politicians in an election year need those people on their side. So I think we should consider all of these factors when we're expecting what the market is going to do over the next couple months. And when I lay out this thesis for you guys, it makes me hesitant to expect a lot of upward price movement, sustained rallies, when we're still in a climate where the people in charge of the money are terrified of inflation and are trying to create a reverse wealth effect. The last thing we will touch on today is quantitative tightening. There's a lot of talk about QT and what it is. All quantitative tightening is the Federal Reserve allowing assets to roll off their balance sheet. So when the Fed buys treasuries, what they do is they continually reinvest those treasuries rather than allowing them to expire and roll off. They're always replacing them. They keep their balance sheet at a certain size. But quantitative tightening is when they allow those assets to mature and they don't replace them. Sometimes they sell them, but in most cases, they simply allow them to mature. And that is what is known as the reduction of the balance sheet. Quantitative tightening is the opposite of quantitative easing, which is the growth of the Federal Reserve balance sheet. And quantitative easing is what began in the wake of the Great Financial Crisis and the Ben Bernanke Fed back in 2008. So I've got a lot of data here on the screen, and I'll try to keep this concise. Up at the top, we've got the Bitcoin price. And in red are periods of time where the Federal Reserve balance sheet was reducing period over period. Down here in the center is the Federal Reserve balance sheet, this thick black line. You can see it's up here around $8.5 trillion. And this is only the part of the balance sheet with the Fed that are treasuries and mortgage-backed securities. Those are the two cogs that people pay the most attention to. There are other things on their balance sheet, but here we're only looking at those two because those are the two most important. The gray bars in the background behind this line represent the monthly change in the balance sheet. So when you see it positive, it's growing. Here you can see it was growing really significantly over the last few years. And down here at the bottom, lastly, these blue bars are the same as these gray bars. They're the balance sheet change, but they are as a percent of public debt. Now, there's a lot of zeros on here, a lot of tiny values. In the past, times when we've had quantitative tightening, they've been relatively mild in pace. The most aggressive pace of QT that we have ever seen was in 2018 and 19, when the Fed was reducing the balance sheet by as much as $50 billion a month. That sounds like a lot of money. And back then, at that time, that pace of quantitative tightening was 0.15% or so of the debt at the time. See these values here? Negative 0.11, negative 0.17, negative 0.16. Very tiny percentages of the overall debt. But at the time, it was a very aggressive pace. And this period of quantitative tightening came during the Bitcoin bear market. Now, it began at the end of the parabola of 2017. I see a lot of people point that out. QT started during the strongest part of the bull run. Yes, it did. But quantitative tightening usually accelerates over time. And it did here. You can see when they began it, it was only 0.01% of the debt, 0.02%. And I'm using the debt as a baseline to give you a sense of scale. They're not actually rolling off total public debt. It's parts of the public debt. It's the treasuries and mortgage-backed securities that they hold on their balance sheet. But doing it as a percentage of debt gives us a sense of scale. And so when QT was accelerating, it was still at a really slow pace, and that was the Bitcoin bull run. But by the time QT got to a pace of about 0.15%, we were deep in the bear market, deep in it. Well, friends, starting in June, quantitative tightening will begin at a pace of $47.5 billion per month. At the current total public debt levels of $30 trillion, that is 0.15% of public debt as a pace of QT. That is the value from right here, from when when QT was the most negatively effective on Bitcoin and asset prices broadly. That's the pace we're beginning at in June. And by September, quantitative tightening will have accelerated to $90 billion a month, which at current debt levels is 0.3% of the public debt. That pace of QT has never been seen before. It is a road untraveled. Now, I'm not here to tell you that just because we had a bear market during this QT, we're going to do this exact same thing. You can't say that with certainty. However, the data does suggest that Bitcoin and risk assets do not perform well when you have aggressive quantitative tightening. And the pace of QT that we are about to embark on is the pace of the most aggressive QT we've seen so far. And within 3 months, that pace will double. So I think we need to be a little bit more realistic. And when people are calling bottom right here simply because we had a big wick on the day that Luna collapsed and thinking that that is a capitulation and that marks the bottom for Bitcoin, there's still quite a bit of data that suggests we're not out of the woods yet. I'd love to be wrong, and if I am, I'll be the first one to admit it, and I will adjust my thesis if conditions begin to improve. But right now, everything I'm looking at with what the Fed is talking about, with the wealth effect that we explored, with the pace of quantitative tightening that we're talking about right here on your screen, with the weakening of the American consumer, which will have an effect on GDP, I just don't think that we're in a position right now where we can confidently call bottom. I'm observing this market and I'm waiting for conditions to improve, for the haze to begin to clear. A weakening of the American consumer may be a harbinger of the beginning of that, but we need to see inflation coming down month on month for a series of months before the Federal Reserve will begin to soften its stance. So we're still a few months away from that. That's what I wanted to talk about today. This was a thick video. There were some very heady topics in here, and I understand that some of you may not still be on board with me now after we've gone through all that. If you have questions about this, if you have feedback, please leave them in the comments down below. Let's generate some discussion around this. I think this is the most important topic we could be discussing right now. So it's important to me that everyone feel like they understood the points that I was making. So let me know what you think down below. We'll give the market some time to play out, and we'll talk again later this week. So if you have a long-term thesis about Bitcoin, we are in a value zone. But because of many of the concerns I've expressed, it's too early to assume that we've reached bottom just because we had an ugly day last week, an ugly capitulation wick. There's still many headwinds in front of us, and we need to temper our expectations for the next quarter or two until we at least see conditions beginning to improve. Until we meet again, take care of yourselves. Don't let these things make you overly stressed. What stresses me out is not knowing what's going on. But if we continue to pay attention, if we educate ourselves and we stay aware, we keep our finger on the pulse, we're going to make it just fine. So keep coming back, keep watching the videos, keep engaging in conversation, and stay hungry to learn. So that's it. That's my soapbox. I hope you all are having a good week so far. We will chat in a couple of days. Be kind to each other, take care of yourselves and your families, and we'll chat very soon. Cheers, everyone.